Alexandria Real Estate just released disappointing third quarter results and caused its share price to drop quite a bit. I just spent some time reviewing the result, listening to the conference call, as well as studying the latest data from major brokers, and in today's video I'm going to share with you the good, the bad, and the ugly. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and before I go into today's video, I wanted to clarify that I've been wrong about Alexandria Real Estate so far. I first invested in the company at much higher levels and I have seen its share price gradually decline. However, I have not lost hope. On the contrary, I remain as bullish as ever and I have regularly bought the dips in order to accumulate a larger position while the share price remains heavily discounted. I take risks to earn returns and not all my picks perform well. Alexandria Real Estate is a good example of that, so keep that in mind as you go through today's video. I've been wrong so far and I might be wrong again. Okay, let's start with the good news from the latest quarter. Most importantly, the long-term investment thesis has not changed materially despite the near-term difficulties. I know that it's hard to hear that right as we're going through a down cycle that's hurting the company's results, but ultimately it's our long-term expectations for the company that determine whether we decide to keep holding our position or to sell it. And nothing major from the last quarter indicated that the long-term story would have changed for the worse. This means that we still think that the current oversupply will prove to be temporary and that Alexandria's growth will eventually accelerate, which will lead to a significant re-rating of the stock. As I've discussed in previous updates, the current oversupply is very significant and it will take a few years for the market to regain balance, but we're very confident that it will. The new supply that's currently under construction has dropped to a historically low level. Many life science buildings that are currently vacant are now being leased as offices, and eventually we expect the AI revolution to accelerate the research as well as to lead to a boom in new small biotech formation, all of which will lead to much more demand for the properties of Alexandria. This is going to take a few years, but given that the stock is now trading at just about 1/3 of its peak valuation, we think that as the growth accelerates and the narrative changes, Alexandria's share price could easily double or more from here, and that is why we still like the long-term investment thesis and don't plan to sell our position. That was it for the good news, and now we shift to the bad news, which is that market conditions have worsened since the first half of this year. The supply situation has been clear to everyone and has not changed materially. However, what has changed for the worse is the demand side, and we think that this is mainly because of the current administration's policies that are causing significant uncertainty and delaying leasing decisions. The Trump administration has proposed or hinted at several measures that could hurt Alexandria's tenants. This includes a potential 100% tariffs on importing drugs, a new most favored nation drug pricing policy that would seek to peg US prices to the lowest levels abroad, third, a crackdown on direct-to-consumer advertising, fourth, major cuts to the budget of the NIH and other research institutions, and fifth, the Trump RX direct sales framework is also potentially going to disrupt traditional distribution models. Many of these policies may never come to life, but they are still leading to very significant uncertainty. And as a result, many big pharma and biotech companies are now reducing their research and development spending. They're also delaying expansion plans and even subleasing some of their own space. It has all contributed to weaker near-term demand for life science properties, and as a result of this, Alexandria recently missed its expectations for the third quarter and had to slash its full-year guidance. The REIT now expects to earn 2.5% less FFO this year, which is not very significant, but more importantly, it sends a negative signal as we go into 2026. Same property NOI growth has come below expectations, and its latest asset dispositions have also been done at lower prices due to the worsening conditions and negative market sentiment. There's just too much chaos between the threats of major import tariffs, strict price controls, cuts to fundings, and other restrictions, and this is now reflected in weaker demand for life science properties. That's very bad news. And now we get to the ugly, and this is where it gets scary, especially for income-oriented investors. Alexandria seemed to hint in the earnings release that they may cut the dividend going into 2026 in order to retain more cash flow and avoid increasing its leverage. The weaker leasing coupled with asset sales is reducing its cash flow and increasing its leverage at the moment. Therefore, the management noted in the earnings release that they expect their debt to EBITDA to go from 5.2 times currently to a range of 5.5 times to 6 times by the end of the year. Even then, their balance sheet will still be one of the strongest in the REIT sector with a BBB+ investment grade rating, but it will continue to gradually deteriorate from here, and they could potentially limit the damage by reducing their payout ratio and retaining more cash flow. For this reason, they are now considering a dividend cut. This surprised the market and explains why share price dropped so much. Everybody was surprised, me included, because on paper Alexandria's dividend seems to be perfectly safe. Its payout ratio is relatively low at about 60%. The company has also a multi-year history of steady dividend hikes. I'll put a chart on the screen. It has a strong BBB+ investment grade rating with very long debt terms at 11.6 years. Only 7% of its debt is expiring by 2027. It has ample liquidity to cover those maturities. And finally, it still has very attractive long-term growth prospects despite dealing with some oversupply today. So what changed so suddenly for them to start considering a dividend cut? And I think that's simply what I mentioned earlier. And I don't mean to blame it entirely on the Trump administration, but again, I think that their attacks on the big pharma and biotech sector with threats of major tariffs, stricter price control, cuts to research and so on have changed the near-term demand outlook, and this is really the major change that is now causing REITs like Alexandria to consider cutting their dividend. But to be clear, this doesn't mean that Alexandria is going to cut its dividend 100%. So far, they just said that it's under consideration that they were going to review their dividend policy going into 2026 due to these growing headwinds. However, as you know, when a REIT hints at a dividend cut, they often follow through with it. And Alexandria has historically been very conservative with its balance sheet and its payout ratio, and it seems to me that they likely want to continue on that path. Income investors will of course hate this, and many will likely sell the stock simply at the threat of a potential dividend cut. But for long-term oriented, total return investors like myself, this really doesn't change the outlook that much. If I owned this business privately and I knew that it was likely going to go through some tough times, I would likely also want to play it safe and retain more cash flow to make sure that the company is on solid grounds to survive and eventually live to see better days. The dividend is ultimately just a capital allocation decision that has no impact on the underlying value of the assets. The REIT market has sometimes a tendency to overreact and negatively punish companies that cut their dividend, but that's also not always the case. Just look at how much Healthcare Realty, ticker symbol HR, has surged ever since it's cut its dividend a few months ago. The market saw it as a positive move because it allowed the REIT to retain more cash flow in order to pay down its debt and accelerate its growth. Will the same thing happen with Alexandria when it cuts its dividend? I don't know, I don't have a crystal ball, but it seems to me that when a dividend cut makes sense from a fundamental perspective and the REIT is already heavily discounted, the market will then not further punish the REIT, and I think that this could be the case here with Alexandria. So what's the takeaway here? And the main takeaway is that the near-term reduction in demand is a clear negative to the thesis and it warrants a reduction in our buy under price. By the way, if you want to access all our buy under prices, they're exclusive to the members of High Yield Landlord. I'll put a link to a 2-week free trial in the description of this video in case you want to try it out. However, the long-term outlook has not changed materially. I think that the policy uncertainty will eventually stabilize, demand growth will accelerate and catch up to the supply. It will take a few years given how severe the oversupply has become, and this near-term demand weakness will likely further lengthen this period of oversupply. But given how heavily discounted the stock has become, we still view this as a great long-term buying opportunity for investors who can look past their current troubles and focus on the long-term recovery. Real estate has always been cyclical, and times of oversupply are commonly followed by times of undersupply. That's because developers eventually get hurt, they scale back projects leading to very little new supply, and eventually the demand catches up to the supply, leading to undersupply. We've seen this happen time and time again across many different property sectors. The latest one was senior housing. Rates like Welltower used to be very heavily discounted, offering a great buying opportunity for investors like ourselves. We used to own Welltower, but as the oversupply turned to undersupply, share price more than tripled over the last few years. I think that Alexandria today, trading at near all-time lows, is now offering similar potential for the coming years as it eventually recovers from this period of oversupply. It will take some years, and I cannot perfectly predict when the market will regain balance, but the upside potential is so significant that even if this takes 3 to 4 years, so more than a couple years, I think that ultimately the expected annual returns are very attractive here. For this reason, we will keep holding on to our position. We're also not rushing to buy more of it because we already own quite a bit and want to keep diversifying our portfolio. But if it keeps dipping from here and reach new 52-week lows, we will likely buy another tranche at High Yield Landlord. If you want to gain access to all our transactions in real time and all our best research, you can join us for a 2-week free trial. We'll also give you immediate access to my real money REIT portfolio. It's the first link in the description of this video. Thank you very much for your interest. Let me know if you have any questions about Alexandria Alexandria or any other REIT in the comment section. If you could please click the like button, subscribe to the channel, that helps me a lot to keep on growing. Thanks so much and see you at my next one. Bye bye.